My coworker Dave just texted me a screenshot of his home equity line, $210,000. He wants to use it to buy a piece of a bank. I didn't tell him no, I called Frank instead. Everyone thinks owning a bank is the closest thing to a legal money printer. But 3 real American banks disappeared in the last 3 years, and Frank told me the fastest one didn't take months or weeks. It took less time than a single work week. The thing that killed them wasn't bad loans. It was something quietly sitting on a balance sheet that almost nobody outside the industry knows how to read. There's a 4th bank in this story too. But Frank made me hold that one until the very end, because it's the one that changed how he invests, personally. He spent 40 years inside that world, so I put him in front of a camera and made him explain it to me like I was 12. Quick reset, I'm John. This channel is where I document my own money decisions in real time, mistakes included. No finance degree, no family office behind me. When I don't understand something, I go find someone who's actually lived it, and I bring you the conversation. If that's the kind of channel you want, subscribe. New episode every 2 days. No fluff, just the numbers. Now let's get back to Frank. Frank spent his career underwriting the infrastructure other people's money runs through, power grids, toll roads, and for a decade, small regional banks. I told him about Dave's plan. He didn't laugh. He just asked one question.
Does Dave know what he's actually buying? Because it's not a vault. It's a machine that turns other people's trust into money, and it only works as long as the trust holds. A bank takes money that isn't its own and turns it into loans, bonds, and credit lines that generate income every single day. The deposit never disappears from the customer's side. They can still log in and see it, but the bank has already lent most of it to someone else. That's not fraud. That's the entire business model, and it's been legal and standard since before either of us was born. Here's what people skip. Before Dave's group takes one deposit, U.S. regulators expect them to clear 2 separate approvals, a charter from the OCC or a state banking authority, and deposit insurance from the FDIC. That alone typically runs 1 to 3 years and, depending on the size of the bank, several million to tens of millions of dollars in capital that has to be the group's own money, not borrowed, not depositor funds. And that capital has to sit there permanently as a cushion. Larger banks need a minimum Tier 1 buffer around 7% of risk-weighted assets. Community banks usually target a leverage ratio around 9% of total assets, though regulators just finalized a rule this year lowering that community bank floor to 8% starting this July, specifically to give smaller banks more breathing room. Dave's $210,000 doesn't clear the parking lot. That's less than 2% of the capital floor he'd actually need.
Frank wanted me to see the fast version of failure first, the one that took less time than my own work week.
Take a California bank that spent a decade becoming the go-to name for crypto companies. Deposits were fine, until its biggest crypto clients got spooked by trouble in the wider crypto market and pulled their money out within weeks. Management chose to wind the bank down and repaid depositors rather than wait for regulators to do it for them. That bank had survived 35 years in business. It didn't survive one concentrated, panicked exit by a small number of very large depositors. Notice what didn't happen. Nobody defaulted on a mortgage. The loans were fine. What killed it was that too much of its money came from too few people who could all leave in the same week.
Then Frank showed me the slow version, and this one scared me more because everyone involved looked competent the whole way down.
A San Francisco private bank spent years writing enormous, ultra-low-rate mortgages to wealthy clients, a real perk of banking with them. Those loans were fixed for decades. Then interest rates jumped faster than they had in 40 years. Suddenly, the bank was sitting on a mortgage book paying it far less than it now cost to attract deposits. In one quarter, that bank's deposits dropped from around $176 billion to about $104 billion. Regulators seized it and sold nearly all of it to the country's largest bank for a fraction of what it had been worth 2 years earlier. Wealthy clients aren't more loyal than anyone else. They just have better information. And they moved first.
2 banks. 2 completely different customers, completely different products, same ending. And I remember thinking about my own net worth sitting in index funds and a savings account, not a mattress, an actual bank. and realizing I'd never once asked what happens to it after I hit deposit.
People assume this is a uniquely American problem. It isn't. That same March, a Swiss institution older than the United States itself, one of only 2 banks the entire country was built around, had to be folded into its biggest rival in a single emergency weekend, arranged directly by the Swiss government, because confidence had drained out faster than any balance sheet review could keep up with. A bank that survived 2 world wars didn't survive 3 weeks of headlines. Size doesn't save you. Age doesn't save you. The only thing that ever saves a bank is depositors deciding, collectively, not to leave.
So I asked him the obvious question, if none of this is about bad decisions, what actually determines who survives?
Let's actually run the numbers for a small bank like the one Dave wants to buy into. Say it manages to lend out $75 million and it earns a healthy 3.2% spread between what it pays depositors and what it charges borrowers. That's about $2.4 million a year in interest income before anything else. Now subtract payroll for a lean team, core banking technology, compliance and legal, FDIC insurance premiums, loan loss provisions, and occupancy. Add it up, and a good year nets this bank something like $450,000 in profit against a capital base of $10 to $15 million that Dave's group had to put in before a single loan was made. Now the bad year. Rates move 2 points against you while half your loans are locked at the old rate. Your spread compresses from 3.2% to under 2%. Interest income falls by close to $1 million. Your expenses don't move. You're now losing money every single month, and that's before a single borrower defaults. 2 bad years back to back, and a bank this size has burned through roughly a quarter of its entire capital cushion. 3 bad years, and regulators are calling. That's the trade Dave is actually being offered, and it's the same trade sitting underneath every dollar you've ever deposited anywhere.
I called Dave back that night. I didn't tell him not to do it. I told him what Frank told me. He's not buying a vault, and he's not buying a stable paycheck. He's buying a leveraged bet on interest rates and on a few thousand strangers not panicking at the same time.
The families who built fortunes owning banks understood exactly one thing that never changes. When you sit in the middle of the flow of money, you collect a toll on almost everything the economy does. That's the reward. The cost is that the day trust runs out, no amount of capital moves fast enough to stop it.
Before I let Frank go, I asked him the question I actually cared about. Not what happens if Dave buys a bank, but what happens to the rest of us who just keep our money in one.
3 things, and none of them take more than 5 minutes. First, check that your bank is actually FDIC insured, not assumed. The FDIC runs a free tool called BankFind Suite, and every legitimate bank has to disclose its certificate number. If you can't find it, that's your answer. Second, know your number. $250,000 per depositor, per bank, per ownership category. Above that, in a single account, you are the last person the FDIC pays back, not the first. If your balance is higher, split it across account types or across institutions. It costs you nothing, and it isn't complicated. Third, pay attention to duration, not headlines. A bank in trouble doesn't usually announce it. Watch whether they're chasing deposits with unusually high rates. That's often the first visible sign that the balance sheet underneath is under more pressure than the marketing suggests. That's the whole difference between being a depositor and being an owner. As a depositor, the insurance and the diversification protect you. As an owner, like Dave's about to become, there's no FDIC for your equity. You eat the loss first.
Dave still hasn't decided. I'll tell you what he does once he does. If you want to actually understand what you own before you own it, not after. That's this whole channel. Subscribe and I'll see you in 2 days. Remember that 4th thing Frank told me changed how he invests personally? It's not a bank, it's a ranch. Next episode. Why a man who spent 40 years underwriting banks put a chunk of his own money into land and cattle instead, and the number that made him do it. Subscribe so you don't miss it.